There are 457 leveraged ETFs that trade in the U.S., compared with a total of more than 4,300 ETFs overall. That's according to ETF.com. And leveraged ETFs have a total of about $160 billion in assets. So what are leveraged exchange-traded funds? The SEC first allowed them in 2006. They're designed to boost the returns of a specific index or asset that they track. So while a traditional ETF tracks securities on a one-to-one basis, leveraged ETFs typically aim for a 2-to-1 or 3-to-1 ratio. Leveraged funds use various investment strategies, such as the use of swaps, futures contracts, and other types of derivatives to accomplish that goal. Due to their compounding effect, investors can enjoy higher returns in a very short period of time, but leveraged ETFs come with significant risk as they also magnify losses. Plus, they tend to be more costly and they can be less tax efficient as they can generate capital gains throughout the use of swaps and other derivatives. We expect at least one more interest rate cut before the end of the year, and as rates fall, many investors are seeking ETFs that capitalize on looser monetary policy. We're joined by Will Rind, Granite Shares founder and CEO. Will, it's good to see you. So we were just sort of explaining the concept of leveraged ETFs. You all have a pretty broad suite of different kinds of leveraged ETFs. And something that is in, I guess, the same family, but not quite a leveraged ETF, is your yield boost product, which is linked to this idea of rates coming down. So can you, first of all, just explain the product to us?
Yeah, thanks, first of all, for having me, Julie. Good to see you again. So yield boost ETFs are options-based income ETFs. So they're designed to generate high income on a weekly basis. And effectively how they do that is they sell options on underlying assets. In our case, these are leveraged ETFs, and that generates a high weekly distribution for investors.
And have you seen an uptick in demand because of the rate cutting cycle?
Yeah, it's really two things at work here. So on the one hand, it's rate cuts or the anticipation of rate cuts and people wanting to generate higher yields. And the other one is that, as the market ticks higher and higher, it's people effectively converting growth into income. So maybe thinking that instead of continuing to buy the market, I'll buy a high income fund whereby I'm not speculating on the upside of the market, but I'm changing or converting that growth into income today. And I think those are really the two most pervasive trends that we see.
Will, as we just talked about, when you're talking about a leveraged product or something tied to a leveraged product, there is an increased risk. So what do people need to know? This is as an old friend of mine who covered the ETF industry used to say, you have sort of like green light, yellow light, red light on ETF products in terms of their sophistication, and leverage probably all goes into that red light bucket, right? So what do people need to know before they get into these kinds of products?
I mean, this is a classic, trade-off, as with most investments in terms of risk and reward. So with yield boost funds, you'll see yields, annualized yields or distributions, in some cases as high as 170, 180%. And so for anybody that is looking at that, they rightly will ask themselves the question, how's that possible to generate that kind of yield? And the answer is in the strategy that we provide, which is selling options on underlying leveraged ETFs that themselves are highly volatile. So you were able to generate high yields, but of course with that comes a higher element of risk. In other words, there's more volatility in a yield boost ETF than there is in something like a US Treasury. And then in order to try and combat some of that volatility, we also buy or use bought put options to offer some downside protection as well for investors to try and insulate that. But like I said, the basic trade-off here again is like classic risk and reward. Higher yields, but higher risk.
Well, while I have you, you guys have a gold ETF too. That is one of your, if not your biggest products. So I imagine you're pretty busy with that one at the moment as well. What kind of activity have you seen in there, and what does it tell you about how sustainable this rally is going to be?
Yeah, I mean, look, unbelievable. Myself, I'm a big fan of gold, as you know, have been for many years now. And even I've been surprised by the move past 4,000. I thought we would get there, but I didn't think actually we'd get there this year. So the velocity of that rally in gold has been something astonishing. Even more so, perhaps, and this is probably something that investors don't know much about, is the rally in platinum. We have a platinum ETF, PLTM, which has outperformed gold. And I think what you're seeing here is just a broader allocation to real assets or hard assets. So gold leading the way very much so, but followed by other precious metals as well, such as platinum.
Will, great to see you. Thanks for joining us.
Thank you.